In today's COVID conversations with Westbrooke, we are joined by Gavin Beekman and Michael Stein from Pensam Capital in the USA. They're one of Westbrooke's key partners in America. And we wanted to touch base on their views on the market, on multifamily. That's the sector in which they focused. Pensam, just by way of introduction, is a diversified multifamily investment company. They were founded by Gavin and Michael, along with a third partner, in 2009. And since then have invested circa $3.5 billion into multifamily assets in the form of equity, in the form of debt, and new developments as well. They play across the multifamily spectrum throughout the USA. And gentlemen, thank you for joining us.
Pleasure, nice to be on the call.
Thank you. Great. So I think just to maybe, Michael, to start with you, just to get your views generally on the impact of maybe the containment measures associated with coronavirus. What are you seeing at your portfolio? I mean, certainly in terms of the assets we own together, rental collection has been quite strong, but just more generally, what has the impact been and what are you seeing?
Right. So thank you for having us. And as you pointed out, Jonathan, collections were well in excess of any expectations that any multifamily operators have had. In April, we were north of 93, 94%. In May, we were north of 98%. And what we're finding is that residents are prioritizing paying their rent. Certainly, the U.S. government stimulus as well as unemployment benefits that residents get has helped propel those rent payments. But I think what we found is that the asset class is resilient to a large degree, and that our residents really are prioritizing having a roof over their head. And when we're in this shelter-in-place, world, and people are working from home and not going into office, their residence is a place of refuge and necessity. So we're finding very strong collections and residents being very responsible in this era.
And we've seen that across the board over the 23 areas and states that we operate in. So even in terms of our management company that we are part of, the 95,000 units, we've actually seen this has been a constant. It's just not a regional thing. It's all over the US.
Brilliant. And I mean, maybe sitting from far away in South Africa, there's the fear that there's a lot of government stimulus that may be aiding tenants to pay. Is there a worry on your side that there'll be like a delayed impact from these measures, from job losses, etc.?
There's certainly caution, Jonathan. We're taking a very conservative and defensive approach in terms of how we manage cash at the asset, how we manage distributions. Sure. And clearly it's early. I mean, we're 2 months into this, going into the third month, and I think there's definitely uncertainty, and there's not clear vision in terms of what the impact is beyond, and when the benefits wear off, and how much more the government is going to be involved. So, Gav, you probably have something to add to that, but
yeah, I mean, in terms of vision going forward, it's extremely difficult.
Yeah.
I think what we're trying to do is just manage things day by day.
Sure.
That's all we can really do. But it does also depend on the class of the asset. We've seen there is a differentiation between the class of the asset. The C, D grade assets seem to be a lot more effective. 70% of the job losses come in the area of people who are earning less than the $39,000. So it seems to be a lot of the impact now initially has been on those category of people and assets, C, D grade assets. That being said, the payment plans that have been given to businesses have kept a lot of people employed. Hopefully, people are going back to work now. So we found probably a 10% job loss across our assets. So it's not as severe as the rest of the country by virtue of the class of assets that we do own.
Yeah.
But we're just taking it day by day. So as Mike said, we're trying to be as defensive as possible, building up cash to weather the storm. So far, our expectations have been exceeded on the collection side.
Brilliant. We've been obviously very happy with that. There is this, maybe the media is blowing it out of proportion, but there's this red strike movement that I know has maybe gained some traction, possibly in states where you're not active. Is that something that concerns you?
Yeah, I mean, we've seen it a couple of the states we are in, like, for example, out in Colorado. Denver is a pretty liberal place on a big property that we own out there. We had actually somebody had chalked it onto on the ground, strike rent and stuff like that. And but we haven't seen it translate. At the beginning of this whole episode, I mean, we were pretty nervous because every governor was saying different things. We had no idea if people would actually pay rent. So, no one was saying go into the grocery store and take whatever you wanted. So it was pretty odd that governors would be saying don't pay rent. So we haven't really seen a big, any assets significantly, even in some of the liberal states that we're in, being significantly hurt. But it's pretty early, and I just keep on having to reiterate that we believe. I think the good thing that has played out here from a real estate perspective, just to have some positivity here, is multifamily has played out once again as being the most offensive real estate asset class that you can be invested in. And albeit that there have been significant gains the last 10 years in the space, and it's really performed extremely well, both in terms of capital appreciation as well as cash flow. It's just proven out once again compared to other asset classes, just how resilient it is. Yeah, no, it's great. In terms of the market, sort of states opening up, people getting back to work, travel maybe opening up a little bit, have you seen movement in that regard? And then also just in the market, Michael, are you seeing opportunities at all? Is there any activity? Do you have a sense of whether prices have shifted down significantly or not? And just really what you're seeing maybe in the sort of very recent past 2 weeks, has the opening up had an impact on activity?
Yeah, well, clearly most states, if not all states, are open or will be open in the next week. So it's early to say what the impact of that is, because they're now just starting to open up beaches and restaurants and travel and those sort of things. The second part of the question, which we're following on a day-to-day basis, which is transactional activity, we have to separate transactional activity into really two parts. There's the investment sales side of the business, or the equity acquisitions on properties that we're buying and that we own. That transactional activity has been really dormant. I mean, if a seller doesn't have to bring their property to market now, they're not going to do so in the next several months. I mean, only if there's pressure do I believe a seller will be bringing their property to the market. Pressure in is either a loan maturity or high leverage capital stack or partners that want to get out. So I don't think that's really going to translate into any meaningful buying opportunities. From the anecdotal information I'm hearing on the few transactions that are getting done, maybe there's a 5 or 10% discount on pricing on the very small handful of transactions I've heard about. But for the most part, valuations are holding pretty strong on the apartment side. Where there is opportunity and where we are seeing deal flow is on the debt side of the business. So mostly in the new construction, lease up, A-class property arena, because those properties have time sensitivity in terms of takeout. So they're mostly on construction loans, and those construction loans have maturities, and lenders on those construction loans are either unwilling to extend, or they're willing to extend with certain covenants like principal pay downs or increased debt service coverages. So things that we are seeing are bridge loan opportunities where we can come in and take out a construction lender and provide short-term capital to bridge it to permanent financing.
And we're working on a few of those, yeah. And we are working on a few of those at the moment.
Right. I mean, we'd love to see them when they're ready for Westbrook and our clients. In terms of, I mean, maybe it's early to now answer this question in light of what you've just said, but rates have dropped substantially. I'm wondering if the impact of that will be felt by equity participants such as ourselves. If we start buying assets again alongside you, will the benefit of those rates flow through lower rates, or are banks or financiers increasing their spreads such that to cater for additional risk, possibly, such that we don't see the benefit of that lower rate of funding?
And for right now, rates are low, spreads are holding firm. So
the agencies, on the agency side, they're holding firm, where we do most of the finance.
Yeah.
The caveat. The NDS market has actually spread a little bit.
Yeah. But on the primary, Freddie and Fannie finance over 50% of the multifamily market, and most of the institutional type of stuff that we do, they have held rates low. The spreads are low. The index is low. The terms are favorable. We participate in monthly select sponsor calls with Freddie Mac, and they're liquid and they're open for business. And if we did have an acquisition opportunity, clearly I think we'd benefit from low rates today.
Brilliant. Great. Then just maybe one last question on your outlook. I mean, as you said, you're operating day by day. If you can just tell us, like, firstly on that, how that's going. I know you guys, prior to this, when back in the good old days when I could meet you in person earlier this year and towards the end of last year, we discussed how you use technology in your underlying businesses to price rentals and to see daily statistics on rent collections, etc. How has technology been implemented?
It's been playing an incredible part. I mean, just even to in terms of the leasing that we've been doing, and we haven't really given you too much data on this, but we can. But the leasing through this whole period has not slowed at all. In fact, end of March was probably our busiest, leasing period that we've ever had, and it was in the middle of the lockdown. And all of our leasing that we've been doing has been doing online, with people, signing agreements, even looking at the apartments, over telephones or computers, which 3 months ago, I mean, if we had discussed this, I would say it was impossible. So it's been incredible just seeing how people have been adapting and just how comfortable they are. And I was actually on a call last week, and I was asking the management team at a couple of properties, are people disappointed when they come in and see the properties because they did everything online? And everybody has. I mean, we haven't had any complaints at all across the whole portfolio on people doing leasing online. So it's quite amazing how comfortable people are getting doing things like this on Zoom. From a productivity standpoint of our business and our staff, I think people are working harder now than they've ever worked. Productivity has actually, I'd say, increased, Mark. I don't know how you feel.
Yeah.
But we normally had our asset management teams add assets at any point in time. We'd probably have 6-7 people on the road visiting assets, and we've been able to do a really good job asset managing with the people on the ground and just having all our staff at home. Different software also in terms of even payment plans, because obviously we had to roll out certain payment plans across the portfolio to allow people who may have lost their jobs have options to pay us over an extended period of time. The data that we're getting from that and just how efficient the software has been on that has been also exceptional. So absolutely, technology has played a big part in us being able to successfully manage the business and be at home.
Sure.
And do leasing.
Brilliant. Yeah, it's good to hear. So will you go back to the office?
We just signed a new lease in January for 5 years for way too much space, but we'll see.
We got an office for you down here, Jonathan. We have we carved out a nice corner for you with a beautiful view. So
you can take 5,000 square feet. It's no problem.
Yeah. Even put your name on the door.
Hope to be there soon. When the South African government allows me to travel, I'll certainly come. But gentlemen, thank you for your time. Really great to chat, and good to have you on Westbrooke's COVID Conversations.
Good. Great.
Thank you. Be well, John.
I appreciate your time and be safe. Thank you.
Thanks a lot.